Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss additional tax law changes, jobs data and drama, increased standard deduction for seniors, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Doing well. Yeah, going through a little bit of a heat spell here, and it's, that time, charity golf tournament season, so I'm going to be out there sweating pretty hard this weekend, but at least it's for a good cause, right?
Yes, sir. Yes, sir. Looking forward to it. All right. Well, let's dive right in. Additional tax law changes. With the passing of the One Big Beautiful Bill Act, there are a number of changes to the tax code that will potentially impact some taxpayers. So let's dive into some of the notable sections that have been changed. I mean, there's temporary deductions. There's all kinds of stuff. This is going to be really interesting, I'm sure, for all you folks at Plan Solutions come tax season. Where do we want to start with this?
Yeah. There's going to be a lot to sort out, and the agenda here is kind of all over the place, right? Because of it. So we kind of, lump together several of the tax changes that are going to, affect maybe a few people here and there, right? Not real broad. And then, as you said, we'll circle back and we'll talk about the one, the increased standard deduction for seniors that's going to have more of a broad impact. And, as we promised that we would circle back on this, the One Big Beautiful Bill Act and talk about some of these changes. And we've been getting a lot of questions about them. So one of them that's kind of interesting is the, no tax on overtime, right? And I think kind of the theme that you'll find here is each of these, changes were basically talking points from the campaign, right? So I guess on the one hand, you can say, well, a lot of times there's talking points or promises in the campaign and then there's no movement, right? In this case, there was some movement, but I think it wasn't really what people expected, right? A lot of caveats, a lot of limitations. So it's not really the broad impact that people were looking for. But the no tax on overtime. So there is some reduced tax on overtime. Basically, the way it works is, if someone hits overtime, let's say they've done their 40 hours for the week, and now they're going to get paid time and a half for any additional hours. Well, the portion of that time and a half that's their base rate is still subject to taxation, under the same rules. The halftime that's added to that, that is the portion that would qualify to not be subject to taxation, right? So it's actually kind of a lot small. People, thinking, oh, the time and a half was going to be, non-taxable. Well, no, the base rate's still taxable. The halftime is not taxable. Better than nothing, but obviously that's a pretty small portion of it. And then there's some limitations. The amount that someone can get tax-free is limited to $12,500 for single filers and $25,000 for married filing joint. And then also the deduction phases out. So a single filer, once their income gets over $150,000, they start to lose the ability to get that tax-free benefit. And for married filing jointly taxpayers, once their income's over $300,000, they start to lose the amount that they can claim.
Yeah, it's interesting that this is the way it's panned out. So if I'm kind of understanding and punch holes in my basic math here, you earn $50 an hour, you go into time and a half, $75 an hour. So it's that additional $25 an hour that you're making in the overtime that would not be subject to taxation. But that base of that 50, that's still going to be taxed at the normal rate.
Exactly. And of course, you may still have FICA, Social Security and Medicare taxes taken out, right? So you're probably still going to see the bulk of the taxes that would have applied. But there will be a small benefit, right? And again, something's better than nothing. Um, there are some additional limitations. So you have to be a non-exempt W-2 employee to take the deduction. There are, I believe, certain industries where they don't qualify. But, in essence, it's an added benefit. People don't really need to do anything. It's supposed to, the employer is supposed to track it and report it on the W-2 so that it'll show up on the tax return. And so, make it pretty easy for people to report and get that W-2 and see that a certain portion of their compensation, may not be subject to taxes depending on income limitations.
All right. Thanks for the clarification on that. What is happening with auto loans? This is really interesting. This was not something I was expecting until I read the personal financial review on this.
Yeah, and as we've talked about, right, every time they try and do something with autos, it's just so complicated in terms of what cars qualify. It's just, I think it makes every tax planner, tax preparer's head spin and very frustrating because the devil's in the details. But basically, for a new car purchase that's made between 2025 and 2028. Up to $10,000 per year of auto interest may be taken as a tax deduction. And importantly, it's not an itemized deduction like mortgage interest, right? Where your itemized deductions have to exceed the standard deduction. It's actually a separate below the line deduction, so you don't have to itemize. But there are some, restrictions, limitations. So to start, the vehicle must be new, not used. It has to be for personal use, not business use. Although if it's for business use, there may be some other deductions still available. And the vehicle weight must be less than 14,000 pounds. So, right there's a limitation. And then the challenging part is it must meet the final assembly in the US rule. So, if it doesn't qualify from that standpoint, then you wouldn't be eligible to deduct the interest on auto loans. And then it also comes with a phase out. So for single taxpayers, once their income's over 100,000, they'll start to lose the deduction until eventually it could be completely zeroed out. And for married taxpayers, when their income hits 200,000, it starts to be phased out.
Yeah. It seems for the most part pretty cut and dry, except with that understanding of the weight limit must be new and that final assembly, which sometimes that seems to be the hardest thing to really nail down what that is. You might have a perception that, oh, it's a GM car, so it must be final assembly US. Not always the case.
Right. Yeah. And I'm sure there's going to have to be something where, dealers and things will be able to certify that so people know that they will qualify. Under the old rules, we did have some ability to look up VIN numbers online, under the EV rules that are going away. So maybe there'll be something like that for the final assembly rule. But this could be a pretty nice deduction, right? With where interest rates are. I mean, car loan rates are pretty high. It could be, pretty easy to get to that $10,000, auto interest deduction. And so at least if you're looking at those high interest rates, if you're able to get some tax savings there, maybe that brings the effective rate down to something more reasonable.
Yes, sir. All right. Well, finally, the new tax law will give some taxpayers a deduction for charitable contributions, which, I mean, there's always been that, but this is a nice, well, I don't know if the word nice is it. It's a change to how that works.
Yeah, this is kind of an extension of something we had following the 2017 Tax Act, right? So the 2017 Tax Act was the first time they really increased the standard deduction. And so that made it so that far fewer people were going to be itemizing their deductions. And the concern was that that would really hurt charities because a lot of people may not get a tax benefit from donating to charity. And so that law gave like a $300 per person, $600 for married filing joint that you could claim as a charitable tax deduction without having to itemize your deductions. But that was pretty short-lived. It expired as a part of that 2017 Tax Act. So now they've kind of re-upped it, but expanded it. So now you can claim a deduction of up to $1,000 for a single taxpayer and 2,000 for a married filing joint. And so it's just an additional deduction that would be added to someone's standard deduction. So, it's not a huge amount, but for someone that, still wants to, support charity, or, maybe gives to their church, or, supports, the local, foundation for the Kiwanis Club or Rotary or something like that, at least on those first few dollars, they will get some tax benefit.
Yeah, and for clarification around that, when we see itemized standard deduction around charity, you still have to give proof of charitable contribution. It's not like it's just given, correct?
Correct. Yeah, yeah. You still have to have the records. There's no, a lot of times people say, you say, did you make any charitable contributions? And they'll say, oh yeah, just give me the standard amount. Well, there is no standard amount, right? You have to, it's what amount did you actually give that you can substantiate?
Yeah, so yeah, upon substantiating your donations up to that 1,000 for single, 2,000 for a married couple.
Correct. Yeah,
Yeah.
correct.
All right, appreciate the clarification. Anything else before we jump into jobs data and drama?
Well, some of these changes are pretty small, not likely to have a big impact. Maybe if someone's able to benefit from the $10,000 auto interest deductions, that could have a benefit. But a lot of people have asked, should I be changing my withholdings? Should I be doing this? And, in most cases, when we run it out, even if they're going to get some benefit, it's pretty minor. Not enough to change the tax planning strategy, because of these small tweaks to what we've seen in the tax bill.
Yeah. All right. Let's dive in. Jobs data and drama. The big news recently was the weaker than expected job report for July. According to the Bureau of Labor Statistics, the U.S. economy added 74,000 jobs for the month, which was well below that 110,000 jobs that were expected. What do we see here? What are some of the signs of maybe why that growing labor market weakened a little bit?
Yeah, or has it? This has just been crazy. It's so hard to figure out what's going on, right? So, it makes sense in July. Okay, jobs came in a little bit weaker than expected. Probably wouldn't have been a big deal, right? Maybe you'd see a little dip in the market. People would revise expectations down a little bit. But the bigger news was that there was big revisions to the number of jobs that the Bureau of Labor Statistics said were added in May and June.
Mm.
The originally they had reported 125,000 jobs were increased in May, and revised that down to just 19,000 jobs. And then they revised the June jobs number from 133,000 to just 14,000.
Wow.
So, really big revisions. Basically, not only did July come in a little bit weaker than expected, but we lost 225,000 jobs from the prior 2 months. So that put the average job growth at around 35,000, which is still job growth, but it is obviously a lot weaker than what we had thought was happening or what we were seeing.
Yeah, well, and the drama continued. This is the drama part for sure. In addition to that, President Trump fired the head of Bureau of Labor Statistics. As you stated here, this is an example of shooting the messenger. He's not the statistician.
Yeah, it's like I said, it's tough to figure out what's going on. Yeah, because on the one hand, a statistician whose job is to report the numbers as accurately as possible. If the numbers don't come in the way you would expect, right, it should hardly be their fault. But then on the other hand, when we're seeing these really big revisions, you have to question, are they really doing a decent job of getting those numbers? I just know in the 30 years that I've been following economic data, I've never seen anything like this in terms of the big revisions, and they're always to one side. And this is not the first time. We had a revision. The number of jobs added from March 2023 to March 2024 had been revised by 818,000 jobs.
Wow.
Right? That's a lot to be off. And so, what is it with the labor statistics tools that aren't accurately reflecting these real-time changes? And then there's some question of, is this even correct? Because when you look at other sources, the unemployment rate, which is based on a different survey, only increased 0.1%.
Hmm.
So we're saying these jobs weren't added, but somehow we haven't seen an increase in unemployment. And then the bigger one that we look at is the bigger thing that we would look at is initial claims for unemployment insurance. That tends to be the leading indicator of a weakening job market. And those have been hovering right around 200,000 per week, which is a strong number. That's considered pretty low. So we're not seeing, signs of labor market weakness elsewhere. But we are seeing these big revisions that are, hinting at that. So, where is the truth between these different data sources, and how, as economists, business leaders, do people figure out what's really going on so they can make informed decisions, which really is the important part, right? Take the politics out of it. We want business leaders and economists to be able to have a pretty good idea of what those trends are.
Yeah, and I can only imagine that struggle. I mean, this is a big, quick headline that would be like some kind of uh, indicator, so to speak, of especially someone like me that's your average investor, not a day trader, but I read something like this and it might put me into a place of panic. And when we don't understand all the different factors and calculations and stuff they use to come to these numbers. So it's an interesting scenario that we're in here when we would just like to know some fact around this.
Yeah, it's hard to make decisions in real time when you don't know if months later or even a year later you're going to see big revisions, and it's gonna change the facts that you're trying to base these decisions on.
Yeah. Anything else you want to add before we jump to increased standard deduction for seniors?
Well, I think it's just, we're going to have to continue to look at a broad source of data around the labor market to get a real idea of what's going on in the economy as things continue to come out, and try and use the mosaic approach, as they call it. Each data point is like one tile. You put enough tiles together, you start to get an idea of the picture. So this is just one piece, one tile that's kind of changed color or looks a little different, but it hasn't really happened broadly. Question will be, is this, will we start seeing shifts in other areas too that start to change the broad picture? Or is this just kind of an outlier that, maybe it's due to some statistical tools or things like that is causing some distortions?
Yeah. All right, let's jump into increased standard deduction for seniors effective for the 2025 tax year through the 2028 tax year. Individuals who are age 65 or older may claim an additional standard deduction up to $6,000. Where did this new deduction come from, and what do we really need to help people know? Again, as a situation of filing single, married, joint, so on and so forth, and how is this affecting those 65 and older?
Yeah, so this is the workaround for the campaign promise of no tax on Social Security,
Mm.
right? It seems pretty simple. Okay, you just stop taxing Social Security, which historically has been taxed on a sliding scale, kind of complicated the way it's done. They weren't able to get that done, and probably because the costs would have been just tremendous. The amount of Social Security income that is taxed and the tax revenue. So they came up with kind of a compromise that's really not a direct corollary, but basically said individuals age 65 or older could get an additional standard deduction. So again, don't need to itemize. If you do itemize, it may not benefit you, right? This is
Mm.
added to the standard deduction of up to $6,000 per person. So 6,000 for single, 12,000 for married filing joint. So this could have an impact on a broad number of people, right? It's not kind of those kind of niche little changes that we were talking about earlier. But there are some things to be aware of. So there are limitations based on the modified adjusted gross income. So that's basically everyone's income, total income, except you add back the portion of Social Security that's not taxable. You also add in things like tax exempt interest, a few other, minor items. And then the phase out for single filers starts at 75,000. and for joint filers starts at 150,000 and it phases out over the next 100,000 of income. So in essence, the way to look at it is for a single filer, the minute they hit 75,000, each additional dollar, they're going to lose 6 cents or 6% of that amount from that increased $6,000 deduction. Once they hit 175,000 of income, they will be no longer getting a benefit. And for single filers, it's at 150,000. For every additional dollar of modified adjusted gross income, they'll lose 12%, right? Because they're getting the 6,000 times 2 for 12,000. And at 250,000 of income, it'll be completely phased out. So it does create some real, tax planning opportunities. Another kind of area in the tax rates that we have to be aware of, where you not only have your, normal, kind of points where the tax brackets change, but now you have points where certain deductions may be reduced, right? Once you get over a certain amount of income, you still have the Medicare IRMA, which is the income related, Medicare adjustment amounts that kick in at different things. So, there's so many different kind of bending points in the tax curve where a few dollars can cause the taxes to go up, or a few dollars less of income can cause the taxes to go down a fair amount. So it really puts, tax planning at a real premium going forward.
Yes, sir. Absolutely. Anything else that you would like to add before we jump to the Plan Solutions Incorporated Office Bulletin Board?
Well, kind of as I stated before, I mean, I've worked through some of these calculations with clients. We've looked at, okay, does it make sense to, make some big adjustments or reduce income, maybe try and get by on a little less to, claim more of this credit and get a little bit more tax savings. And in most cases, it was really pretty minor, right? It was the equivalent of about 2.5% of their taxes. So an additional, $10,000 of income was going to cost them an additional 250 above what it would have done without this change in the provision. And for a lot of people, that just wasn't enough for them to, cut back on their standard of living or cut back on the income that they have access to, and obviously, some of the lifestyle choices they want to make with that. But sometimes there can be multiple of these factors that kick in at once, and then it can increase the cost benefit quite a bit.
Yes, sir. All right, let's jump on over to the Plan Solutions Incorporated Office Bulletin Board. One item pinned up, and it's exciting news. New members of the team.
Yeah, so we've talked about, last year we had 2 summer interns for the 2024 summer. They did a great job. They both still had their senior year in college to go. And so we made offers to both of them. And we've talked about how Carter joined kind of early in the year, went full time as soon as he finished his degree at Sac State. And then the newest member, Matt Young, he finished his degree from Oregon State his past spring semester. He took some time off. His family was doing some traveling and things, and then a little bit of a gap before joining the workforce. But he officially joined Plan Solutions on July 30th. So he's getting onboarded and figuring all the kind of basics out, getting acclimated. But I think it'll work really well. He'll be joining Carter now. They're both studying for the Certified Financial Planner exam. They're learning how to apply the knowledge and skills they learned in college to real world situations. And then, really helping out the office in general by supporting a lot of the financial planners in the office, kind of as a paraplanner role or in a support role as well.
Yeah, that's exciting news. I love to see that. Well, Mr. Armour, anything else you'd like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, I've had a lot of questions from clients when we've met about some of these tax law provisions, right? We've talked about there's a number of changes. I mean, most of the recent tax act was just an extension of the 2017 tax act. So a lot of it is just kind of more of the same, not changes. The plans that we already had in effect, will still be valid, fortunately. But people have had questions about a lot of these different changes. So, by all means, if people are wondering how some of these things may affect them, or if they're trying to plan around some of those opportunities, give us a call. We'll be transitioning soon into the fall, which we consider tax planning season, when we will be having a lot of those meetings. But there's no reason to wait. If people have questions, we're always willing to be proactive.
Yes, sir. Absolutely. And if you need the contact info for Plan Solutions, it is in the podcast description. And we thank you for listening or watching the podcast. That's right. We do have a YouTube channel, youtube.com/@plansolutions. And you can follow along to the personal financial review, the written content we discuss here, along with the podcast. Or if you're on Apple Podcasts, Spotify, and it's your first time, hit that subscribe button and make sure that you share it with someone else who might get value out of the podcast. And if you have yet to subscribe to the Personal Financial Review, please send Katie an email, katie@plansolutions.com, and she'll get you subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast. Plan Solutions is a registered investment advisory firm.